3, 2, 1, action.
And we're on. All right.
Back again.
End of November. Almost.
Man, I was just thinking the other day, it was August.
Yeah.
We took that little trip, and I was thinking about it, and I was like, holy cow, it's like almost 6 months ago.
Yeah. Time is flying. No doubt about it.
Freezing outside.
Yeah.
And I don't care if you live somewhere up north and you think we're crazy. It's freezing. 35 is freezing.
It's crazy because the weather's been the same pretty much from Boston to D.C. I've been tracking that like all summer, and
I
it's
don't
weird.
like that.
Nah, it really within a degree or two, which is weird because it's supposed to be significantly colder up there than down here.
If you see me start walking south, you know why. It's just gotten too cold for me.
Yeah. Nah, it's crazy. All right.
What do you got this week, man?
It was a busy week, right? Pretty great Thanksgiving and all that.
A little bumpy.
A little bumpy in the market. We're going to get into it. The interesting thing is, obviously several days, if not weeks before we do the show, we think about things that we're going to do as the core of the show, right?
Yeah. And the market happens.
And the market happens, and sometimes it goes sort of in our favor along the lines with what we wanted to talk about that week, and sometimes it doesn't. But this week happened to go exactly along the lines of what I wanted to talk about this week. Right? So here's what we're going to do. The core of it is how to make reallocation decisions. So I'm going to go through some of the things that we look at to make reallocation decisions. They may be on your list of things to look at. We all have our personal circumstances and risk tolerance. And I have a list of things that I look at. It forms the sort of the bias and the tendencies of what I think where I think the market's going to go. And then just because I think it's going to go that way, there are other lines in the sand and technical indicators that tell me whether or not it actually is going that way. And then, of course, at the end of all that, we have to apply it to the 2 moves a month and the noon rule. So I'm going to kind of get into kind of how at least I work through all that to finally come to making a reallocation decision. And the bonus chart is going to be Zoom. And then we'll look at the 2-year weekly charts. All right. So making a reallocation decision, the link that I put at the bottom there goes to what we call the mechanics of an alert. It's up on the Smart Read tab on the site. You can go to that and take a look and see exactly kind of the short-term process of what we do when we put out an alert. Okay. So here are some of the things that you really need to think through, right? Time frame is probably the first one. If you only want to track your TSP on a monthly basis, let's say, you're looking at a certain kind of chart. If you want to look at it once a week, you're looking at a different chart. It's a chart of the same, say the C fund, but it's in a weekly instead of a monthly, where each tick is a week instead of a month. If you're looking at it on a daily basis, you're looking at a daily chart. And then intraday, which gives you a lot of good information, but as we know, since we only have the closing price in TSP, intraday, we can't trade it, but it can give us a bunch of good information. So once you figure out the time frame that you're actually working with, then you're watching the chart and you're looking for some kind of a break, right? The pattern, say the market's going up, it goes up and down, but it's going up in a pattern. When there's a break in that pattern, or a break in a trend line or moving average line, or whatever your line in the sand is, whatever the trigger is for you, you see it. So now you're at a point where I think I need to make a decision. So okay, if I make a decision to move from the C fund to the G fund, let's say, what's the next? Once I make that decision, if the market goes down, like I thought, in this case, I think the market's going to go down. Where is the next support and resistance level? So where do I think it's going to come down to before I have to make another decision to get back into the market, right? So basically I'm saying here, you're thinking one step ahead. That's what that is. All right. Once you get that, now you're looking at where are we in the big scheme of things, in the Elliott wave pattern, in the market cycle, however you want to look at that. In the earnings cycle, this isn't just Elliott wave count. It's the big picture. Where are we in the big picture of things? And then the last thing really is seasonality. So historically, is this moving out of the stock funds, let's say, does the market historically go up during this time that I'm thinking about getting out, or vice versa? So it just creates for me a bias of whether or not I want to kind of but try to, because I know if I get out of the C fund, let's say, when historically the market goes up, I know I'm bucking the system, and I just have to put that into my calculus, basically.
Yeah, it doesn't mean you won't do it. It just means you need to know that you're kind of going against the historical trend versus the current, shorter time span trend.
Right.
And when you say historical, you're meaning more like 10, 20, 30 year.
Yeah, I'm going to show the two historical charts. We've done them a couple times over the past few weeks, but it goes back to 1950 to 2020 on the S&P 500, so our C fund, and it, this week of November is historically an awesome week for stocks. This week, obviously not the case. So, if you only use seasonality as a way to trade, you got crushed this week.
Right.
I mean, crushed. So anyway, and then you take all those things into consideration, and then you have to apply the 2 IFT per month rule and the noon rule, right? And the one thing I left out, because it's different for everybody, is your personal risk tolerance, right? This is extremely important, but at the end of the day, the market doesn't care about your risk tolerance. So the technical pieces are the most important in terms of making the decision, but you also have to be able to sleep at night, and that's where your personal circumstances and risk tolerance comes in. Okay. So first thing we're going to look at is 3 different time frames and their patterns and trends, and how you kind of think through that. So here's a 3-year weekly chart of the C fund. I only put in these 2 kind of main trends over that 3-year weekly, but you could draw some shorter trends in there also. But if you're only looking at your TSP on a weekly basis, then each tick, right, each vertical movement on the chart represents 1 week of price movement. So in the first one, in 2019, we were in this pretty well-established trend, right, channel. We got identified tops, we got identified bottoms, we can draw the lines, great. We broke out to the upside there at December-ish of 2019. And so what you would do basically is, as the market continues to move up, you would redraw those trend lines. So the channels change depending on what the price does, right? If you redrew this trend line, you may have gotten out earlier on the crash for COVID, right? If you didn't worry about that and you just watched it, this week price opened right at the top of that channel line, and then during that week went all the way to the bottom of your channel line. So you had to make some decisions in there, right? If we say, okay, we broke out of the channel here, a weekly gap down, and that put us back into the channel, you might look at that and say, okay, this channel represents a pretty good percentage move, and I don't want to take that because I'm expecting the market to come down at least back to the bottom of the channel line like it has throughout the year. And I don't want to take that move down. So I'm going to go to the G fund. If that had been your decision process, you woke up that day on the gap down and said, all right, I don't want to take that. I don't want to take the move back down to this lower channel line. So I'm reallocating to the G fund. You didn't know that this whole thing was going to happen, right? But you saved yourself this whole loss if you did that. You expected to save this section because you expected the market to come down to the lower channel line. But it didn't. It kept on going. So great. You just saved yourself close to a 35% loss. Same kind of thing in this channel. right? We had a big recovery off of COVID. We got a bit of a correction here. We got a breakout above this high, so you're back in, right? If you were watching this trend line and you got out, okay, the market does its thing. We finally had a breakout back above this prior high, and you're back in. This isn't obviously not the only methodology that you can use to track this stuff, but it gives you lines in the sand. So it gives you a reason to make the trades rather than greed and fear and hope. Okay, so then from basically this breakout, the market continues to bang along this line up here, right? And then we had this correction in September. So if you connect, these lows, then your next support level is somewhere at this line here. So if that's the case, if you're looking at, you're only watching on a weekly basis, you're not too worried about the week that we just had, because you haven't had a change in the trend until we get below this line, right? So in terms of the trend, the longer term trend, this week that we just had is insignificant. It's significant on a percentage basis. So if you're looking at if you want to be on the right side of the trend on a weekly basis, you're still there. But if you're looking at your account, you lost 2.2% this week. So you can't do both. You can't look at your account and freak out about the dollar value that you lose and say, but I want to be on the longer term uptrend. It doesn't work that way.
Yeah, it doesn't work that way. Yeah, I mean, and it's even more frightening if you're not using a methodology. Like if your methodology is hope,
yeah,
right? If your methodology is hope and wish, then you're watching that happen. You don't have those lines drawn,
yeah,
and so you have no perspective.
Right.
We've talked about perspective a lot,
right.
And see these trend lines, and I hope people can see the simplicity of what you're doing here. He hasn't thrown up any Elliott wave. There's no Fibonacci going on.
We're going to get to that, but I know. This is very simple.
But
yeah.
This is how I, if I don't have Jerry around, right? This is how I do it. I just draw on a line, and I'm like, all right, well, these are my lines, and I feel comfortable that this is, yes, I may lose 3-4%. I'm not going to lose 30.
Right.
I'm not going to lose 50. And I'm going to get back in and get it is a very simple way to approach it. And I hope people can see the simplicity in what you just did and take away from this that it could be just as easy as that. Now, are you going to be in and out at the perfect times? No, you're not going to, but you're going to grow your retirement account, whether we're talking about TSP, 401k, or IRA. You're going to grow those accounts over your lifespan, and you're going to be very happy.
Yep. You actually just had a good point, and
it's rare.
No, it triggered a little thought. A lot of people say, you don't get out on a down day, right? And my question is, okay, if you're not going to get out on a down day, that implies you're going to get out on an up day, right? And so if you look at this trend, since the breakout last November, we've ridden this upper channel line, right? So at what point along the way there would you have gotten out to avoid this September correction?
Or back up to the earlier trend line down there. When would you have gotten out there?
When would you get out? How can you get out on an up day? Like I can't get my mind around, other than to say, well, if I get out on an up day, then I've made the most money. Yeah,
well, you and I know the answer. The answer is that's the narrative that the financial media have just built into our brain, right? Because they are looking at it from a totally different perspective.
Sure.
They're probably not talking about your retirement account. And when you hear them say, you never get out on a down day, right? Because you want to go buying cheap. You're buying cheap,
yes,
right?
Right.
Well, yeah, kind of, yeah, but it's not the same.
No, it's not. If I'm trading, right, and we're going to get to that on Zoom, because Zoom is the bonus chart, right? If you're trading and you don't have the 2 move a month rule and the noon rule and all that, you can say you put up an Elliott wave pattern of a stock like Zoom, and it breaks out and you buy it. It goes up say 20%, and you say, all right, 20%, I'm good with that. I'm gonna take those profits. I'm gonna sell it, right? It can keep going up. You don't care because you took your 20% and you moved it on to something that is in a base and breaks out, and now that pattern, that setup, is a better use of your assets than something that's already 20% extended, right?
That methodology doesn't work in the TSP.
Absolutely not.
Just doesn't work.
Can't do it.
Yeah.
Okay. All right. So that's the weekly perspective, right? If you're only going to look at your account once a week, that's kind of this is the chart that you would use. If you're looking at your account every day, it's the same C fund, but it's a 1-year daily chart, right? Where each vertical tick is a day. So in this one, rather than drawing the trend lines, I have the 10-day moving average and the 50-day moving average. Okay. So very simply, you can see the 10-day moving average is the blue line, right? For most of the time, the price finds support at the 10-day moving average line for the majority of the time throughout the year. When it doesn't find support at the 10-day, it generally finds support at the 50-day, right? Unless it doesn't, which it didn't here. So if you're looking at it on a daily basis and it breaks down through the 10-day, let's say up here, right? We're pretty far extended from the 10-day to the 50-day, meaning I don't know if I want to accept this loss. So if it breaks down below the 10-day, I might get out and then get back in when it hits the 50-day, right? That's conceptually, that's how you could do it. If you are, well, let's say right here, there's a very small difference between the 10-day and the 50-day. So you look at it and go, well, all right, it's below the 10. It broke below the 10-day today, but if I'm expecting support at the 50-day, it's only like a 1% move, and I only get 2 moves a month, so it doesn't make sense to sell it here. If I'm expecting support here, maybe I would sell it here if it broke below the 50-day. Right, so you have to figure the value. Basically, if it breaks the 10-day, okay, what's the next level that it's likely to go down to, and how far down is that level? If it's not very far down, then you don't sell it at the 50-day, right? So those are just some of the things you're kind of thinking through. So we fast forward to where we are now. Since the breakout in October above the 10-day moving average line, and then it broke above the 50 and kept on going. Broke above the 10-day, got above the 50-day, kept on going. It rode the 10-day moving average line for basically the whole month of November, right? We are pretty far above from the 10-day to the 50-day. So I don't really want to take this loss, okay? So if it breaks below the 10-day, because I don't want to take this big move down, right? I'm going to sell it below the 10-day. So that's my sort of decision process, because I'm looking at this and I'm going, all right, we've had a big run up, we've consolidated. If it breaks down, I don't want to take that loss down to the 50-day, so I'm going to sell it. So that's the decision process. On the day that it does break below the 10-day, which was Friday, right? If you're looking at it on a daily basis, right, in this example, we're looking at it on a daily basis. So you have no control within the day. The fact that it went down 2.27% on Friday is unfortunate, right? If it had only gone down 0.5%, you still would have gotten reallocated to the G fund, because if it had closed up there somewhere, it still closed below the 10-day, so you still would have gotten out. But you can't control that. In TSP, we can only do the closing price. So if your decision process is to get out below the 10-day moving average line, you know what? It sucks for you because Friday had a big move below the 10-day, but there's nothing you can do about that. So the last sort of time frame we can look at is intraday. So this is 1 month, still the C fund, 1 month where each vertical tick is 1 hour. Okay, so I drew the channel. we got a high, we got a low, we have a higher high, we have a higher low. So the short-term trend is up. On Friday, the market gapped down, huge gap down, right? Opened right there. Okay. And for me, I put it out either on the alert or something. For me, this was, so the first line in the sand for me was the 10-day moving average line. And we hit it like right in there. So I knew I was getting out that day anyway. Then when the market got below this intraday low, that was the absolute line in the sand for me. I was absolutely getting out for sure. So I made that happened about 10 o'clock in the morning. It got to right there about 10 o'clock in the morning. And that's why the alert came out. So by the end of the day, we're down here. It doesn't matter. There's nothing we can do about that. If we had a reversal, if we opened here, the market came down and during the day reversed all the way back up here, awesome. We would have had a much smaller loss, right? Quote unquote loss, and we'd still be in the G fund, but we'd still be below the 10-day moving average line, but we'd have not taken as big a loss as we did. But there's nothing we can do about that. It is the TSP rules, right? If I could have gotten out back here at 46.30, that's when I would have gotten out. But I can't do it. I have to take the closing price for the C fund. So I took the 2.27% decline for Friday. It's just the way it is. Okay. So hopefully that puts some time frame and kind of the things that you look at on a technical basis. Does that hopefully make sense?
I think it did. As a matter of fact, I plan on like slicing this out and throwing it in the Facebook group and separate from the actual show, once the show comes out, because that's a good little explanation, I think. Okay.
So you get the technical piece. The next piece for me is the Elliott wave count. For other people, it could be earnings. It can be whatever the big picture is for you, right? So for me, it's Elliott wave count. So, because you want to know where you are in the big scheme of things, right? So I put a lot of emphasis on Elliott wave, and right now I have two possibilities, right? Elliott wave works in 3 steps up, 2 steps down, and you continue higher till you get to a top, and then it's 3 steps down, 2 steps up. So from the COVID low, the first possibility of the Elliott wave count is 1, ABC 2, 3, ABC for 4, and 5. So are we at the top of the 5 right now? We don't know. But that's one possible count. I don't like this count because usually, not always, it's not a rule, it's a kind of a guideline, but usually the 1 and the 5 are the same length. And so we're not there yet. It doesn't have to be. The 5 and the 1 don't have to be the same length, but we're definitely not there yet. And I don't like the length of this 4 versus the length of this 2. This is a two-month correction. This is only a 1-month correction. And so sort of the look of it doesn't work for me. I don't like the way it looks. So the second alternative, or the alternative count, would be an extended 3-wave. So the first move, and then ABC for 2, and then the 3 would be a 1, 2, 3, 4, 5. That would be the 3, and then we would have a longer term 4, and then a 5 going into next year. I think that's more likely. That's really the count that I'm expecting will happen. So it creates a backdrop, right? It doesn't mean that I'm gonna trade based on that. It's because it's hindsight. Elliott wave is a backward-looking sort of methodology. But those are the two ways that I'm seeing the pattern play out. So, okay, that's a backdrop. The other backdrop is seasonality. So, November. This is how often each day of the year is higher on the C fund, on the S&P 500. So, for example, 78 78.57% of the time on November 21st. 78.57% of the time, the C fund is higher than the previous day, right? On average over the last 20 years. So it's just a backdrop. It just means that historically on that day, price is 78% of the time going to be higher than the previous day. I mean, those are some pretty big odds. It doesn't mean it's going to happen on November 21st of 2021, right? So it's a backdrop. The other way of looking at it is the best 5-day return for the S&P 500 from 1950 to 2020. So November, right? They color coded it, so it's pretty easy to look at. The last couple weeks of November, historically, since 1950, have been very positive for the S&P 500. Same thing with the last few weeks of December. Extremely positive. So you just know that if you get out of the stock funds during the last part of November or the last part of December, you're bucking the history. It doesn't mean you can use seasonality just on its own and trade that way. Again, you would have gotten really, really crushed this week because this week should have been an up week, and it wasn't. Okay, so you put all those things, you take your big picture, Elliott wave or earnings or whatever you're looking at. You're looking at seasonality, and then you've identified a change, whether it's in the trend or a technical indicator moved the other way, whatever. You're looking at a decision point, right? So you put all those things into the pot, and you're like, all right, I'm going to make a reallocation. Now you have to take into account the 2 move a month rule and the noon rule.
Bum, bum, bum.
Yeah. So where we are right now, at the end of November, basically, we had used our first IFT interfund transfer for the month early in November. I'm watching the 10-day moving average line throughout November on the C fund, right? And we're just above it. We're hanging out above it. And I'm watching. And then my bias is I don't want to get out of the stock funds in the end of November because historically, seasonally, is very positive for the stock funds, right? So my bias is not to get out. But I also know that I don't want to take that move from the 10-day moving average line to the 50-day moving average line. Mm-hmm. So I'm looking at all these things, and I have to make a decision. Mm-hmm. And I'm at the end of the month. So I know that I only might have a couple days that I have to hang out in the G fund before I can get back into the stock funds in the beginning of December. So and then as the time goes by, it's to your favor because if you still have a move left, as the time decreases, now you have more flexibility at
Absolutely.
The end of the month, right?
Yeah, you can start off with the next month in the stock.
So you're taking all those things into consideration. If for anybody that doesn't know, this is the rule. You can change your fund investments by clicking Request Interfund Transfer. The request has to be made by noon Eastern Time, and it will generally, it's the TSP out in case it doesn't process for you.
Don't you love that?
Yeah. But generally be processed that night. So you have to have your interfund transfer request in before noon to get that day's closing price. So you're going to take those gains or losses, whatever it is, if you get your request in by noon. You're going to get that day's closing price. And in this case, I had already made one interfund transfer for the month, and it tells you, right, hey, be careful because you've already made one, and you only get 2. And then anything that you do beyond those 2 for the month only move into the G fund. So it definitely tells you the rules. It just doesn't tell you the tactics that you have to use to apply the rules, right? So that's basically everything that goes into the decision-making process to make a reallocation decision if you're using this methodology.
Yeah, and it's not complicated. If you take out a few pieces of those, I mean, Elliott wave is a little difficult to wrap your head around. initially. But I think once you get the gist of it, it makes a lot of sense. And again, it's based on historical data. That's what, Elliott Wave is math and data and history.
Yeah.
That's really where it comes from. It's not that someone, dreamed it up.
No.
It's an algorithm that works, again, more often than not.
Yeah, it's a guideline, right?
Yeah.
And you can use it in terms of market cycle or earnings or whatever. It's just a way to get a visual of where we are in the big cycle,
trend,
right?
right?
So obviously we're way above where we were at the COVID low, right? And everybody knows a crash is coming, right? It's stupid to follow the people that every day say a crash is coming, because most days the market goes up.
Well, it's interesting because I had a conversation with someone yesterday about how they follow this particular analyst, and that analyst has been saying for 10 years that the crash is coming.
Yeah, he's right. It is coming.
He is right. It is coming, and nobody knows when. What you have to do is try to be on the right side of the market. But I think what I think of when you lay out all of those things on your initial slide there is, as you add on more and more indicators, more and more information. To me, this is how my brain works. First, you start with none of those, and you're in the hope range, right? You're in the buy and hope. That's what I think of it as, not buy and hold, buy and hope. And so you're doing that, and then now, okay, well, let's add just a little bit of information, some way to make some decisions. As you increase those, I think your probability of being correct increases.
Sure.
Right? Not the possibility, the probability. It's possible that the market is going to go the other way.
Absolutely.
It's absolutely possible. But as you increase those decision points, the probability that it will goes down.
Yeah, I mean,
I hope that makes sense to folks to understand why, like, you would want to add on these extra pieces. Well, it gives you a stronger probability that what you think is going to happen will actually happen.
Will play out.
Yeah.
I absolutely agree. For me, the more layers you put onto this thing, if a trend line and a moving average line cross over, for example, right? That's a really strong support level. So you would expect the market to bounce, let's say, higher from that. It comes down and hits a trend line that happens to intersect with a 50-day moving average line. The odds of support there are pretty high. And if it breaks down from there, the odds of it continuing lower are greater, right? Because you have all those overlapping things at that point. That's kind of how I use it. It gives you a stronger basis to make decisions from.
Now, I will throw one caveat to my thought process is that, I do believe adding those layers helps you increase your probability of being right. However, if you add all those layers and you start to get conflicts of information, then that confuses you more. Yeah. So with that in mind, if you really don't understand which ones are weighted higher for you, then maybe you don't need those many, because they're just going to start to confuse you.
You can definitely get analysis paralysis from this stuff.
Yeah.
I mean, easy.
And that's why I would really recommend going back, just rewind to that first slide Jerry did. If you're starting in this kind of like trying to actively manage your account and not just being sit on the sidelines and hope, if you're trying to do it, start with the trend lines. Just start there. Yep, and you're going to be magically better off if that's all you do. Once a week, check your trend lines, make your decisions, and just keep your life going.
Moving. Yep.
You're going to be way better off. You would have gotten out at some point during the COVID drop. Yep. You would have gotten out some point before the big, crashes in the past, 20 years. You would have.
Yep. And you'd also get back in.
Absolutely. And you wouldn't have been doing anything, extraordinary other than just following the trend. And it doesn't take but once a week. So,
Good. All right. That was good. Bonus chart, Zoom. So nobody knew, well, some people knew, but basically nobody had ever heard of Zoom prior to COVID. And now we use Zoom is like ubiquitous. It's almost a verb. I mean, I'm gonna do a Zoom call, or I'm gonna Zoom you, or whatever.
Yeah, it doesn't matter what software you're using. You're doing a Zoom call, because if you say that, everybody knows what you're talking about. Right. If you're like, oh, I'm doing a Microsoft Teams call, they're like, I don't know what that is.
Right.
It's hilarious because I'm actually, I know you know this. I mean, I am a geek when it comes to this type of software. I like productivity stuff and all that. And anyway, and I wasn't that familiar with Zoom.
Yep.
I think a lot of things came into play at one time. Great marketing, great
Yep.
name. They delivered on the product. What's crazy is when we first started using it, we were using it to do the show.
Yep.
And it was just clunky,
Yep.
everything. But those guys and gals kept up.
Yep.
And they must have hired like 1 million developers at once to try to keep that going.
I mean, clearly it was a great product that was absolutely needed for the time. And they were the only ones in the market kind of at the time. I mean, teams couldn't do it. You had
Not as seamless.
Right.
Like,
because anybody could just get on a Zoom call. Once
you just click it on my phone on anywhere. Like they made it easy enough. They took all the barriers away. They did a good job.
I mean, FaceTime, you could do FaceTime before that, but you couldn't bring in other people. You couldn't
share your screen right as easy.
There's all these different
a lot of little
things.
things.
And so Zoom was great.
Yeah, the timing was awesome for them.
So let's look at the chart of it, right? Zoom. So this is a 3-year weekly chart, right? So Zoom does an IPO back here for, I don't know, $25 or something back in April or so of 2019. Has a pretty good run up. This is a regular price chart. It's not logarithmic scale. So from 50 to 100 is 100% move on your money. So while this doesn't look like much, this little blip, it's huge, right? So they did 100% gain on their money from 50 to 100. Okay, so does the IPO, comes up, settles down, and so the way, if you're looking at an Elliott wave of this, you have a 1, a 2, and then your 3-leg, ideally would be a 1, 2, 3, 4, 5. You can play around with the different Elliott wave ways of looking at it, but the longer term would be a 1, 2, 3, 4, 5. And we get to the top of an Elliott wave pattern. Okay. So let's say you were tracking that Elliott wave pattern on Zoom and it broke down. If you're connecting the bottoms of those weekly moves, you got out of Zoom up here, right? It went up to like 6, I think around 650 up here. So if you got out down here at 525, you locked in a pretty big loss, but you made a truckload of money depending on where you got in back here, right? And obviously, you saved yourself from this huge decline. So now, I mean, Zoom now is it was about $200. So that's about almost a 2/3 loss, right, from the top. But what actually happened there? You got a big breakout, not coincidentally, right at the beginning of COVID, right? You had a really nice basing pattern in here and had a big breakout right there at the beginning of COVID. Runs up, tops out. Okay. You have a decline down to the 38% retracement level and then a bounce. It failed, right? The bounce failed. So everybody's looking at this 38% retracement level and they bought in, right? You had a reversal candle right there, and then everybody bought in because it had hit that Fibonacci retracement level and did a reversal candle and was going to move higher. And it did for a couple of weeks, and it failed. Fails down to the 50% retracement level. Everybody buys it back in right there. Does an ABC correction. It failed. Gap down and failed. So you're not trying to foresee what's going to happen in Zoom. You're watching what happens and responding to what the market does. You could draw this longer term trend line, and it failed the trend line, right? It comes down to 61.8 and does a reversal candle. Awesome. Everybody jumps back in. you got a double top, and it fails. And now Zoom is down below the 61.8 retracement level, and it's pretty much off everybody's radar. No one's looking at it. Until this week, Kathy Woods comes out from ARK ETFs, if you guys know what that is. If you don't, I would definitely look at it. ARKK is one of them, ARKQ. She has a bunch of different disruptive ETFs that are really good. She came out and bought 600,000 shares of Zoom on, I think, Wednesday this week. And that's why Zoom, well, she bought like 600,000 shares of Zoom on, I think it was Wednesday. And then Friday, you get this South African COVID variant thing that comes out. And Zoom, I swear, I'm watching the ticker on CNBC Friday morning, and the only green on the screen was Zoom.
Yeah.
I'm like, she just made, Zoom was up $15 or something. She just made, I don't know how many millions of dollars on that one trade. Whether or not she, had her, her intel that something was going on in South Africa and she was in on it early. I mean, who knows? But she made a lot of money on that. It was the only green. It was the only green on the screen for quite a while on Friday. And so that's why we started to get that reversal candle. So not Kathy Woods, but because Zoom was the original COVID play. Maybe does it go back up from here? I mean, does the South African thing create a new round of lockdowns and everything else? Who knows? And if it does, all the idea of the post-COVID travel is going to kick back up, and leisure and hospitality and all the stuff that has been increasing here for the past few months. Does that all roll over and we go back to the things like Zoom and Peloton? Peloton was another one that was green. Peloton has been crushed because everybody's going back to the gym.
Yeah.
Now, if you can't go back to the gym, Peloton's going back up, right? They say golf is the best game in the world. I think not trading stocks necessarily, but the whole game of this is like, I don't know. I like it.
Yeah. I mean, the cool thing is to me, the cool thing is that, once I understood that all those lines in there on this chart that we're showing are just people's decisions.
Yeah.
Right. The market is people.
Yeah.
There's huge institutions involved, but those are still run by people. Yep. So institutional money does have a huge impact, right? When somebody comes in and buys 600,000 shares?
Shares. 600,000 shares of Zoom.
Yeah. Yeah, so that's on a different planet than the rest of us retail investors. Yeah. But the point is that, what you're watching is human behavior, put up on a chart. Mm-hmm. And human behavior, it has patterns.
It's repeatable.
It's just the way we're built. And so once you figure that out, and it's not just in this, I mean, it's how people solve crimes. Yep. That's how I learned it, is because people will repeat their patterns, even if they're trying not to. And so that's what happens on these charts, folks. If you're looking at this, and if you're like me, 20, 30 years ago, I looked at these charts. I was looking at stuff like this. And I was just like, that doesn't make any sense to me, And when you start to look at it, and it's fear and greed. And it's people making decisions when they think it's going to happen. So what we try to do is not worry about why. Right.
Just watch that it happens.
Why is important, right? But you only know the why later.
Yeah.
That you might think you know why. We might think it was the variant the other day. In a couple of weeks, we'll know why it happened. Yeah. But that's too late to do anything about it. Right. So what we do is just respond to what's happening. Right.
Yeah. The other thing that was out a lot this week, on Friday particularly, was this idea of panic selling, right? You get everybody jumping on the bandwagon about just because the market's down today, don't sell it because you're selling on a red day and you're panicking and all that. If this COVID thing, if the new variant, whether or not it's like, for example, the Delta variant, when that came out, it didn't roil the markets like this did, right? This was the worst one-day drop in 2021.
Right.
And the Delta variant was a real thing. If you watch the news on Friday, this South African thing, it doesn't even have a name yet. They don't know anything about it, and it caused all this stuff, right?
Yeah. What you have too, though, and this has nothing to do with the stock market, but you have a lot of people with nothing better to do. Yeah. When something like this happens, and we're all sitting around at home on our screens, then there's more panic.
Yeah.
So if this would have
Self-fulfilling
happened
prophecy.
in a very different time frame,
Yeah.
who knows if it would even been a blip, and who knows if it's even, we don't. And so what we do is respond to the market. But
so in terms of panic selling, I would argue that the market was down on Friday, right? And we've articulated every which way. The reason I got out on Friday was because I was watching the moving average lines. Had nothing to do with if whatever the reason was on Friday. If it closed below that 10-day moving average line, I was out.
I know this for a fact that if I called up Jerry and said, Jerry, all the chickens in the world just turned blue and they're not edible anymore, he's going to be like, oh, that's great. Yeah, but it just crossed the 10-day moving average. I'm back in. Right. I know that you're going to be like,
right.
That's great news.
Interesting. Yep.
Yeah, interesting news. However, I'm watching my line in the sand, and if that changes, I'm out. I don't care why.
Right. I mean, it easily, the market could have popped higher on Friday, and this news about this new variant could have come out, and it could have kept going higher, and nobody would have, now a couple of weeks down the road, does the South African thing actually turn into something, and the market rolls over? Sure. And then it would have crossed the 10-day and would have gotten out then.
Yeah.
But it's so the panic selling idea, if the South African thing becomes something,
mm-hmm.
and the market closes lower next week, right? Are you going to look at that then and say, okay, I just lost X amount on Friday, Y amount on Monday. Now it's Wednesday, it's December, and I'm using new IFTs.
Yeah.
Like now you have a much more difficult decision to make,
mm-hmm.
right? If you're looking at it on a daily basis. If you're on a weekly basis, you're still, the trend is still up, right? Now you don't make a decision until it crosses that lower trend line we talked about.
Yeah, a lot of people, if you were playing a more macro game, macro version of this, probably didn't get out.
Sure.
And that's fine because that's where your lines are, and that's okay.
Right.
Now, if it goes past your line, just get out. Don't wonder why. Don't try to figure it out. It's interesting to talk about. I'll jump in the Facebooks, the Book of Faces, and I'll get in there and talk it out with you. But at the end of the day, I don't really care why. It's interesting to talk about, but I don't really care.
Okay. So the TSP funds for the week, and we keep having people ask what the ticker symbols are, and that's why we put this chart up every week. So the C fund, $SPX, or the ETF is SPY. S fund is DWCPF. VXF is the ETF of it. It's easier to find VXF. I fund is EFA. F fund is AGG. All right. So C fund 2-year weekly. If you're looking at this trend, you're still above that 10-week moving average line. I mean, there's nothing to worry about there. If you're looking at it on a weekly basis, you're still above that that moving average line. Everything's fine. The C fund relative to the S fund has ticked back up quite a bit. It had flattened, right? So the S fund and the C fund had been kind of operating at roughly the same percentage level, but the C fund is in the past couple of weeks has ticked up versus the S fund. But if you're looking at it on a weekly basis, you're not making a decision until it breaks below that 10-week moving average line, because you don't want to take the drop down to the 50-week moving average line. Okay. S fund. S fund has been driving all of us crazy for the year because we had a top here in February, and we've got this long-term sideways consolidation, right? It's been going on all year. It's not something that we can trade, at least I don't think you can trade it in TSP because of the 2-move-a-month rule and the noon rule. I mean, you get 3 weeks down, 2 weeks up, 2 weeks up, 3 weeks down, whatever, and it keeps going basically flat. This week back here was definitely a change in that trend. It was a breakout, right? It was a very strong breakout, and it failed. Okay, it failed, rolled back over to its 10-week moving average line. Do we get support at the 50-week moving average line? Maybe, right? That's definitely an area of support that we're looking at. So at this point, the attempted breakout failed, and we're back in the trading range. So there's really nothing to do with the S fund until it either it breaks down from here, or it breaks back up and gets back above this high. There's nothing you can really do with it. It's back in its trading range. iFund, we've talked about. We've been out of the iFund for quite a while. It was the worst performer of the week. Definitely versus the C fund, the iFund is not looking very good. Does it get support at its 50-week moving average line? Maybe. It's already below it. Closed at the bottom of the trading range for the week. iFund is definitely not something that I would be in at this point. F fund. F fund had a big week, basically because when we've had all this talk about interest rates going up, that's obviously not going to happen if the Fed has to pump more money in if the South African variant becomes a thing. So if that is the case, the F fund will go higher, which is fine. We'll make a decision about that at the time. We got lower highs all the way along. So until one way to do it, if you don't want to just be sitting in the G fund, if you connect these highs, if we get a close up here, say 116, actually let's say it's 117. So you get a close up here at 117. Now you have higher lows, and you have higher highs. So maybe there, the trend has changed in the F fund, and maybe that's a fund to be in for a while if the stock funds are going down. But for me, for right now, the G fund is where I'm at. Okay.
Questions?
That's about it for that one. That was a lot of stuff in there. Hopefully people get the idea, at least, of the methodology that we use to make reallocation decisions. I mean, if you don't have a methodology, you are standing around your water cooler listening to your friends. Most people do that. That's how they make their decisions. Mm-hmm. I don't think anybody would make a decision about buying a house or buying a car or buying anything or selling anything just by listening to what people say about it.
Yeah.
So I don't know why you would do it with your TSP funds. You need a methodology. You don't need anything, but I think
you don't have to. You just can't expect to really understand why you did well or you did poorly. And we talk about this all the time. We were talking about right before we started recording the show. The people that go through the buy and hope mentality, which, by the way, I'm going to trademark that phrase, buy and hope.
I like that. I like that.
The buy and hope. You started kind of talking about an analogy of like buying a Ferrari and not having any insurance, right?
Yeah.
And I think that's good. It doesn't it's not it doesn't explain all the facets, but the point is like you wouldn't any car, whether it's a Ferrari or not, whatever, right? If you think to yourself, like, if I wreck this thing or if it breaks down, it's going to cost me hundreds of thousands of dollars, tens of thousands probably, to fix it or whatever, and I don't have that money, right? If you don't, and so you're just hoping nobody runs into you. You're hoping it doesn't break down, but you're driving a Ferrari, and so if you have been lucky enough to have your TSP account over the last 20 years, and you bought and hoped. And you do have $700,000 or $1 million because we've had these huge, swings up. Well, here's what you're hoping for, is that now you're getting closer to retirement, and you're hoping that this crash doesn't happen before because if it happens, your Ferrari's gone.
Yeah, and you don't have any insurance against it.
And there's no hedging. There's no way to get it back because you don't have enough time. And so anybody that has more than $100,000 in their TSP, and for me, that's a lot of money. If I have more than $100,000 in something, I'm paying attention to it.
Yeah,
I'm not hoping, and I'm certainly not going to get on social media and brag about the fact that I have X amount in there, and it all happened because I was lucky.
Yeah,
you can brag about that all day, but everybody knows you're lucky, so it doesn't ring true.
Yeah.
Now, if you say you've built this and you have a methodology that works, it doesn't have to be ours. There's plenty of ways to play it.
Lots of ways to play the game. Yep.
Yeah, but you did it you did it with decision making and not hope. That
Awesome.
Yeah.
I love those conversations.
And I love to talk to those kind of folks, because I'm always looking for other ways that we could do it and kind of, tweak it a little and on all of that, right? So we all win with that. So anyway, take that for what it's worth, folks. We hope you're getting some knowledge out of this. If this is your first show, hopefully it wasn't overwhelming. If it's your 100th show, I don't know how many we've done so far. It's not 100, but it's we're definitely over 50 or so. But anyway, if you guys enjoyed it, please share it with your friends. Put some comments down in the Book of Faces.
Yep.
If you find us on YouTube, all that stuff, we're happy to kind of get engaged. It might take us a little while sometimes, but we do.
Yep.
All right, guys, that's it. We're out of here.